In this video, we walk through the calculation of basic and diluted earnings per share for firms that have outstanding stock options, which from an accounting perspective are the same as warrants. We're told that the Windsor Company's net income for 2021 is $45,100, and the only potentially dilutive securities outstanding were 1,000 options issued in 2020. Each is exercisable for one share at $6 a share. None has yet been exercised, and 10,000 shares of common stock were outstanding during 2021, with an average market price of during 2021 of $20 per share. Let's begin by computing our basic earnings per share. Our basic earnings per share is net income available to common, which will be the $45,100, divided by the 10,000 weighted average shares outstanding. Next, we're asked to calculate the diluted earnings per share. We begin by picking up our outstanding shares, which are 10,000, and then we assume that any outstanding options are exercised and the proceeds are used to repurchase treasury stock. We're told there are 1,000 shares or options outstanding, so we'll assume all of those are exercised and an additional 1,000 shares are issued. We'll take the proceeds from those options, which in this case is $6,000. Recall 1,000 options at a $6 a share exercise price. And we divide that by the average market share price during the year of $20 per share. So we assume we can repurchase 300 shares of stock. This gives us an adjusted 10,700 shares outstanding. So for our diluted shares earnings per share calculation, we'll take our net income available to common of $45,100 and divide it by 10,700 adjusted shares and get $4.21. Notice earnings per share decreased, so the options are dilutive. One thing we want to keep in mind, when the exercise price is less than the average market price, the options or warrants are dilutive. If, on the other hand, the exercise price is above the average market price, the options or warrants will be anti-dilutive. The idea is that if the exercise price is above the market price, we'll collect more in proceeds and be able to buy back more shares than we issue through the exercise of the options, which would make the options anti-dilutive. Let's go ahead and take a look at Part B. We're going to assume the same facts as in Part A, except that the 1,000 options are issued on October 1, 2021. So when we calculate the weighted average number of shares outstanding for the options, we need to use a fraction of a year. Also, we're told the average market price during the last 3 months of 2021, when the options were potentially exercisable and outstanding, was $22 per share. There'll be no change to our calculation of basic earnings per share. It's still the $45,100 divided by the 10,000 shares outstanding. We'll have a difference, though, when we calculate our dilutive shares. We begin with our 10,000 shares outstanding, but now, instead of 1,000 shares being issued through the exercise of options, we will only have 250 weighted average shares outstanding. That's 1,000 options multiplied by the fraction a year they're outstanding, 3 out of 12 months. So the shares that we assume that we repurchase via treasury transactions will be the 250 shares outstanding multiplied by the weighted average share price in the last 3 months of the year. So we'll assume that we repurchase 68 shares of stock, giving us an adjusted weighted average shares outstanding of 10,182 shares. That's the 10,000 outstanding plus the 250 additional shares we would assume we issued through the exercise of options, less the weighted average treasury shares repurchased using the proceeds from the exercised options. Finally, our diluted earnings per share will be our net income of $45,100 divided by our adjusted weighted average shares outstanding of 10,182, and we get diluted earnings per share of $4.43. Again, earnings per share has decreased, so the options are dilutive. But again, we know that because the weighted average share price exceeds the exercise price for the options.